Greetings and welcome to the Zad Mahenna podcast. The following is a discussion with venture capitalist and managing partner at Prudential Digital, Omar Yehia, CEO of Kemet Trading, Mohammed Ashmawy, and partner of the X3E fund, Akash, Nath. I hope you enjoy our discussion. Use the timestamps as you please, and do not forget to like, comment, and subscribe. This podcast will also be available on Anchor and Spotify. Now, for Omar Yehia, Akash Nath, and Mohammed Ashmawy.
Before we address the $10 billion elephant in the room, I'd like to first give listeners the chance to get to know each of you, your background, and what makes you credible to speak on topics within finance, venture capitalism, and crypto. Let's start with you, Omar. What can you tell us about yourself? Get the audience familiar with you and what position you're in right now.
Hi, everyone. It's nice to be here. I'm Omar. I'm a venture capitalist in the Web3 fintech space. I generally have no idea what I'm talking about, so you shouldn't listen to me. Here we are. Ash.
Yeah. All right. Well, I'm Ash. I've been in the financial industry on the TradFi side for the past 7-8 years or so. My entire career has been revolving around building infrastructure for sophisticated hedge funds and buy side firms. Recently, I started a company called Kemet Trading, where we build institutional grade infrastructure for managing crypto derivatives. And that's kind of where my background is. So I do have a little bit of experience when it comes to building these systems. And by virtue of experience as well, I do have certain thoughts and understandings of how the derivative market works in general. But overall, also, I would argue that I'm just like Omar. My knowledge is overall limited. So always do double check whatever I'm saying, and do not take my word as gospel. So
yeah, cool. For the uninitiated, I'm Akash. I've been in crypto for next year will be 10 years. Floated between traditional finance and crypto over that time. Now partner in X3E. So yeah, cheers. Thanks for having us on, Zad. Looking forward to talking.
Thank you, guys, and appreciate the modesty from you, Omar. So before we get to FTX, Alameda, and Sam Bankman-Fried, I wanted to get a view on
what we're talking about today.
That is going to be one of the topics of today, and also hopefully we can paint a picture of the timeline of some of the bankruptcies that have happened over the past 12 to 24 months. But before we get to that, I just wanted to see what's the macro outlook from your guys' perspective. Omar being in venture capitalism, Akash being in the hedge fund space, and Ash working on derivatives technology. What can you describe about the current state of the crypto market? What's the sentiment amongst your peers in the industry? Are you optimistic or pessimistic on the near future? And how would you define that near future in terms of next 1 to 3, 5 years? What's your macro outlook?
Let's keep it simple and let's keep it real. Like the macro outlook for risk assets is shit, and it's been shit for quite some time. And the reasoning, I mean, it's not particularly complicated. You've lived in a world where you've had post the GFC, you've had liquidity driven appreciation of asset values pretty much across every vertical. It's even caught up to commodities. It's even caught up to value stocks. So even that they've had their 15 minutes in the sun. So the problem when you have changes in such a regime is you've gotten a significant proportion of enterprises in an economy that are only designed to operate in low interest rate environments, which is okay to the extent that you can perpetuate that. But if the only reason interest rates are sort of artificially low is because they're suppressed, then the second that regime changes, you have an entire cohort of businesses that shouldn't really be profitable businesses. That's sort of That's sort of one of the premises of having an equilibrium value for the cost of capital. It tells you what is economic. It is the defining line between economic and non-economic enterprises. Crypto is so far off the risk spectrum, you sort of can't even see it. And so when macro conditions are bad, the first money that comes out, it always comes out of the riskiest assets, and crypto is certainly amongst them. And it's typically the last money in. It's sort of the abundance or the excess capital that is unallocated everywhere else across the risk spectrum, then bleeds its way into crypto. So the macro situation is not ideal, but I guess we should take a step back and even ask ourselves what it means to have a sort of ideal macro scenario. I mean, are we in the same regime that we have been in the last decade at least? No. But should we expect the sort of unadulterated appreciation of the price of assets for no other reason except that the liquidity or the balance sheets in general of sort of sovereign issuers of currency just continue to go up? I don't think that's useful, right? That the chickens have to come home to roost. I think the point of having a vibrant, or the meaning of a vibrant economy, is for you to have thriving enterprises that produce value. And that should be true sort of regardless of the monetary regime that you're in. So in many ways, I think this is a good thing, because I think it flushes out a lot of the non-economic ideas that tend to compete for mind space and compete for capital in the space of private markets, or in the space of private companies. How I think it's going to change, I don't think it's going to be sudden. I think it's going to be slow and gradual. I just think you're going to have people revisit business models and economic models of the past and dissect what works and what doesn't work, and go back. There's a sort of return to sanity in terms of valuations, in terms of expectations, growth expectations, liquidity expectations, profitability, things that were ignored in the last 10 years, especially in private markets, where only sort of the top line mattered. Now I think that the bottom line is really going to matter. This is a bit of a spiel. Ash, what do you think?
Yeah, I mean, I think there are a lot of things that I do agree with. They just mentioned cost of capital being one of the bigger themes on just where things are going to be heading. I think it's very simple for anyone to realize that it's almost impossible for anything to always keep on going up, as well as it's impossible for anything to always keep on going down, right? So we're kind of like caught in the middle right now, where people, ever since, I'd say, we had more of a almost like an 11-12 year like bull market, where everyone just thought this is going to continue on forever, and it's not nothing new. I don't think it's unprecedented for people to think that way. These cycles kind of keep on repeating themselves, right, over and over and over again. And as usual, the most bleeding edge of whatever it is that was being invested over the last 4 years prior to the crash, I guess, is always considered like the riskiest of riskiest assets, and that's where a lot of those the immediate hits are very much like felt much harder. And as this thing kind of prolongs, you start seeing capital getting sort of just more and more expensive, even for the further down the road, less riskier asset classes, right? Overall, I think there are two things I guess I look at as someone in my position. So there's the general macro of where is crypto, specifically the macro around crypto altogether, and its use case and its adoption, and where's that going to head in the next like 3 to 5 years. And then there's like the overall like startup scene, right? Like the idea of going out and someone giving you a check to go out and pursue an idea in general, right? To go build something that is new. The risk, within that paradigm is inherent. It always exists. It never is like not risky. But sometimes, it can be a little bit easier to convince someone else that, I might be able to get someone to pay for this because everyone has money, right? But overall, the risk in general of like building something from scratch has always been around. I think right now, from a startup perspective, a lot of people are, on the founder side, are very much sort of, concerned about potentially how can they fill in the shoes, especially those folks who raise that like insane amount of valuations, because everything has to be sort of justified moving forward. So in order for them to continue moving on to the next milestone, they got to grow into a valuation that they probably raised on under the assumptions that anything goes, right? And we're able to fucking just sell a shit coin to someone and make vast amounts of money out of nowhere. And we can continue repeating that cycle over and over again. Now they kind of have to grow into this and prove that, which obviously in a market like this can be incredibly challenging. So I think that's where a lot of the startup founders in general, and again, like not just crypto. So this trend overall valuation is, while it's obviously very much highlighted in the crypto space, it was happening everywhere else, right? Like across the entire startup like ecosystem, things that should not be valued at wherever they should be, and however, you know, people are writing checks because there's so much capital and very little due diligence, and everyone just wants to deploy, and you know, the Fed is just printing money and everyone is happy on both sides, right? So overall, I think from a startup perspective, you know, it's going to be hard for the next like year or two at least to continue sort of building if you are essentially not building anything that is useful or has a long-term like use case, and it's something that is, you know, truly adding value to whatever market that you're working in. I think a lot of this is going to, and I think that's pretty healthy because, you know, like Omar was saying, it brings people back into sanity on each side, right? Expectations from founders of what they should be looking for next in terms of growth, in terms of like raising. The VC side also kind of like getting a little bit more focused on value-added business rather than just hype and following wherever like the market is going. But I also argue that like that doesn't last for too long, right? Like very soonish, and I'm soonish as in like in the next like 3-4 years, I think that will flip again. Nothing as crazy immediately like it happened in 21, right? Or early 22, because those were like repercussions of like an 11-12 year like bull run, right? I don't think we're going to see that again for a little bit, for that long of a cycle. But overall, that's how I look at it from a crypto perspective. I don't see, I'm not too concerned. I mean, sure, the macro is affecting everything, but I'm pretty sure everyone who has been in this space and not anymore, without even having to be in this space, like anyone who's been in tech in general is now very much aware that money is no longer going to be the same 5 to 10 years from today. It's inevitable that we're not going to be looking at currency the same way that we've been looking at it, you know, from that point in time forward. Now, what is that going to look like? No one really still knows, but at the very least, it's like almost everyone knows the inevitability of like things moving on into a digital space. So with that being said, I don't see crypto going anywhere, and if anything, just continues growing. But the question is, which players are going to be in this position to kind of, you know, thrive and become like the, you know, avoid being the Netscapes and actually becoming the Googles, right? So that's sort of, I guess, the open-ended question. But yeah, overall, it's not that concerning if you really are building something that is of value, and it's not that concerning for you as a VC if you have, you know, been investing into quality sort of projects and founders, right? Like it's a hiccup on a road where you know that things are going to be hard to build for.
Easy for you to say if you're one of the 1%, but I can assure you there's a lot of founders and a lot of venture capitalists have made mistakes, and the outcome or the consequences of their mistakes are going to come home to roost very, very soon.
Well, that's why I added that. That's why I added that conditional, right? But again, if you are not part of that, wasn't sane enough to understand that you invested into I mean, honestly, I think a lot of this as well is like goes back to not just whether you're investing in a shitty idea or not, because more often than not, you know, a very strong team can actually create gold out of a shitty idea. That's just happened multiple times, right? The problem is I see even further, and Omar and I, we talk about this all the time, actually. It's like, it's not just about the money that got deployed into projects that seem like they don't have an aim or a goal. It is the fact that like the average talent over the past like couple of years or 3 years so far has been diluted to, quite frankly, shit in this space. Like I came from TrackFi. I was under the impression that everyone is, the majority are very, very smart people, the ones who are getting funded. But you know, a year now into the space, even though I'm kind of isolated from the Web3 movement, like a lot of what we're building really is institutional infrastructure for the TradFi side, right? And I think it's very hard for you to bullshit around that side. But I'm just looking at the wave of Web3 founders. You find people that honestly, I would argue, would have a hard time getting a job like anywhere, right? So
well, maybe it's a good like we can have a little excursion here, because you can tell us. I think we all have sort of very different backgrounds, but maybe you can tell us something. I mean, you've worked at a lot of different shops, some particularly renowned. D.E. Shaw is obviously the engineers that come out of D.E. Shaw are sort of second to none. So maybe from the perspective of someone who's worked in that shop, what do you think of? I mean, I know you've you know, Kemet has hired a lot of engineers recently. You guys are really scaling, but what have you seen from the crypto native side versus the sort of TradFi side? What do you think is interesting? What don't you think is interesting? What do you think of the market for hiring, and particularly what do you think of how expendable some of these positions are relative to, for example, I mean, if you go to Google or you go to Facebook, a lot of what is being done there today is very commoditized, right? You don't need to have a particularly special talent to sort of work at necessarily to fill a lot of these roles. And that's just the nature of large, you know, corporations. So maybe you shed a little bit of light on that, because I know that you're sort of constantly asking. I mean, Ash and I have these conversations where I have to translate sometimes or map some of the realities into like what happens in Web3, because he'll ask me things like, wait, so you can just raise money without having even anything like an MVP, or you can go ahead and you can maybe raise a second round of financing without revenue? I'm like, it's certainly possible. Not only is it possible, it's quite rampant. And so maybe you tell us a bit more about that.
Yeah, I mean, in terms of like talent quality, honestly, it's so I think a lot of people just like really underestimate the effects of just time and being exposed to things that are hard to solve for, right? So while this sounds very generalized, but I'll dive more into like what I mean here, right? A lot of the so-called like founders or building teams in the Web3 space that I've seen so far attempt to build so-called ideas that are incredibly complex at almost every single level, right? Not just the technology, like in terms of like how you actually are going to be able to solve this from technological advancement standpoint, when even the blockchain itself or whatever, L2 that they're building on top of is not there yet. But also it's like the contextuals around like, is this even, do you have a clear idea of like how the formulas are going to work, right? So when we talk about things about like yield or algorithmic, like sort of like pegging, things like Terra Luna, right? Or talking about, dealing with like identity on a decentralized like network, or even like the random other projects that I've seen. It's like the problem that that always seems to like very much like stand out is I always see people that are maybe had a job for a year or two at some very, very like vanilla shop of, not even remotely financial, but just like a job out of college. And then they immediately go out and replicate the abstraction of what white papers look like, and try to add some very smart vocabulary when no one really understands. And at the same time, on the VC side, almost zero contention happens on like, what are you talking about, or what does this mean? No one, everyone's afraid to say these words, when in reality, it's actually funny, but like I argue that like even without having been part of these conversations, there probably happened multiple conversations where someone wrote a check for millions of dollars, and the two individuals on the call that are agreeing on the money terms have no fucking idea what they're actually agreeing on. Like what is the project, what is going to be built, and everyone's happy, right? Like that sort of like circus sort of medium is
one of those. What do you think? It's like a Rorschach card. What do you think is being built? And what?
Yeah, no, right. And again, it's like it's almost like a domino effect, right? Like if you as a founder see some random guy that you went to college with just went out and raised like, $10 million over a fucking white paper, right? And you're like, wait, I had an A in my calculus class. This kid had a C. I could probably do better, right? That's where you're shifting your gears. And then your VCs on the other side, they're like, well, they were fine with it. Why should we ask? Like, we look stupid if we start asking. But that's the scary part, because I think that's why I'm actually very optimistic about like the future in terms of both talent and money, because now it's, that funnel is going to be shut down. Only things that people understand, which should always be the common rule, regardless of whether we're in a bull run or not, are things that are people going to invest in. But I guess we got to a point where things got so crazy in 21 that people were investing in things that even the ones who are building don't understand, right? Which is crazy to think about. But overall, I think it's hard to pinpoint why, because there are very much like very extreme high quality talent also in the space. I'm not saying that the entire space is just like bullshit, but I think it's more about, whenever I hear the term Web3, I see a pattern where the quality goes down a lot more. Whenever I hear things about like, we're building for markets that already are established, right? Folks that come in with experience from other places that are relevant to the space, even because there isn't much space. Like there's no equivalent of a Goldman in crypto, right? There's no equivalent of like a house name, a big institution that is very much focused on crypto only, right? Because you can talk about Coinbase, and I'll tell you, like, the average sound there is honestly not that great either.
So this plays to some of the questions that I have further that have to do with what kind of people you look for when you're hiring, in terms of efficiency and also trust. But I want to give Akash a chance here to give his macro outlook.
Right, Akash is here. Speaking of C's in calculus, we've got the man himself.
To answer the original question, I don't have much to add. I'll generally say that sentiment sucks. It's largely because emotions are highly reflexive and extremely laggard. I don't think sentiment is correct, but that's probably a discussion that we can spend the next 2 hours mulling over. But anyways.
Well, what does that mean? So price goes up, everything is good. Price goes down, everything is, people aren't happy anymore.
No, I mean, it's the very simple meme that people short bottoms and long tops. That's it. People are, I think traders in this space, there's only a handful of traders that have been in this space that actually understand how to trade. I see a lot of folks come in and they kind of treat this as an FX asset class, and they'll intraday trade all day long. They'll do well on small accounts, but they don't really understand how to trade. Somebody who's come from trading like that at the very start to developing programmatic systems and also becoming a very good swing and directional trader, a large part of it is extremely philosophical. Understanding how you can time the market, how you can time emotions in the market, is extremely beneficial to your bottom line. I can count on 2 hands in the last 2 to 3 months the amount of times that we've swung one direction or another direction, solely because of the way people approach the market from an emotional standpoint. This is extremely binary. It's numbers, and that's how it should be approached. It becomes an emotions game because you have, to be honest, lesser people kind of trading it. So yeah, I mean, and that's why I think it is what it is. And then equities macro outlook. Simply put, liquidity begets price appreciation. So liquidity rules all. Play the market as you see it. And right now, obviously, borrowing capital is not cheap. So
right. So going off of that, federal funds rate is currently at 3.8%. And so it's a sentiment that we've been in a recession for the past 12 months. We're at the start of a recession. We're at the worst of it. And also, what does it mean to be recession proof? What is your blueprint coming out of a recession successfully? Is it looking at undervalued acquisitions, undervalued securities? How do you guys prepare yourselves and maintain being recession proof, so to speak?
I'm going to start this off and then hand it to Omar or Ash, but I'm not a macroeconomist. Like Omar, I'm an idiot, probably much more of an idiot. And I know that. So I play my cards as is. I think right now it's going to pay off unduly to be in cash. Right now is not the worst time to deploy from cash. So I have no idea what's going to happen. I have no idea what the Fed is going to do. What I do know is that everything they've said, they've done. They've raised rates, they've done it aggressively, and they've pretty much protected the domestic economy to the best of their ability. So I'll follow suit. I do think people kind of get lost in the pair trade that are tech stocks and BTC. Rightfully so. A lot of the folks that are trading ES, that are trading some of the large tracking indexes that a lot of people traditionally trade, are trading BTC as a high beta asset. I don't know when that'll dislocate, if that'll ever dislocate. Again, not my job to determine it. It's really just my job to trade the market at the time. Recession, no recession. A recession, really broadly defined, has to do with general macro principles, specifically around job growth, rather job decline. Again, I do think a lot of what people do is laggard. So there will be money to be made in between. And again, it's my job for my LPs to find those opportunities. Bitcoin, altcoins, whatever it may be. There will be opportunities in between. And I think that in terms of valuations, Omar probably can talk a bit more about that, but yeah.
Yeah, I'll also, I'll agree with Akash there on it's very hard to generally like predict recessions in general. It's like, the idea here is that when we're in recession, we probably, you'll know when you've been in a recession like for at least a year plus, right? But overall, like there are two ways of looking at this, and that's kind of where the confusion is happening. The job losses are the biggest indicator of like, are things fine, or are we like really slowing down to the point where recession has hit us already? Those numbers still seem like they're very strong. There's not anywhere near enough like job loss to even sort of remotely justify that we're in a recession or about to head one. Even the trends on job losses, I know people tend to just grab signals by like looking at LinkedIn articles or news about like massive layoffs at like tech companies or whatever. But,
like Meta, right? That was one of the big stories.
The funny thing is, like, I mean, even when you look at all these like different stories, right? I mean, tech is one sector within obviously a broader economy, and within that one sector, those layoffs still comprise like literally nothing. I mean, like Meta laying off like 10,000, was it 10,000 employees or some number like that? Was it, or Amazon like laid off 10,000 employees? So people like people were panicking about this Amazon like layoff, like 10,000 employees and being laid off at Amazon is like, that's like a Friday. Like that's just like, it's nothing. Like this is a company that has hundreds of thousands of employees, right? So when you lose 10,000 or you lay off 10K, literally that would not be even newsworthy, except that right now FUD is sort of at the top of everyone's like newsfeed because that's what sells. But realistically, they do get rid of more than 10,000 people at times, and it just never hits the news because everyone is like, oh yeah, it's fine, like it's a bull market. They're just like, restructuring, you're getting better talent, right? But because now the narrative is we're about to all lose our jobs and really hate ourselves, then that kind of news gets attention. But the confusion still comes in because the job losses, numbers wise, nowhere near where they need to be for that recession to kind of like really settle, and people think that we are in a recession. Versus, for example, when you look at like just straight up like numbers, the 10-year to 2-year like yield spread, right? Like on the treasury bonds, right? Already inversed, and that usually is an indicator of a precursor.
Yeah, but like, dude, those indicators, that's the thing. It's like,
I know
everybody likes the narrative fit, so there's going to be a number that makes my narrative look good, right? Everybody's a salesman. I can sell you on whatever I want based on
100%.
But
also, what does that narrative? What does that narrative rely on?
Well, it's typically this idea. It's this idea that when people are longing or shorting either the long maturity or the shorter maturity, that they have something to say about the short-term prosperity versus long-term prosperity. When people are more bullish in short term, the yields on the short tenors tend to go down. People are more short, are sort of bearish on the short term. They go up in relation to the longer tenors. So people talk about this idea of the inversion. Just means what's the fraction, if you're holding bonds, what fraction of it are you bidding at the short tenor versus the long tenor? It's this very old idea that is not very quantitative, and it's just something that people say.
It's a sentiment index.
Yeah.
I mean,
Yeah, it is.
There are some correlation metrics around that specific slope. So it's not like this random. I mean, it has.
And dude, correlation metrics are best fit. I mean,
no, I get it. I get it. I understand. Listen, I'm not the guy who is coming here to kind of promote TA, right, or say the technical. I'm not this person, right? It's especially for things that are super macro, like a recession, which is honestly kind of almost like a natural disaster, to be honest. You'll know, people will just know, right? You'll look around and 6 out of your 8 friends have lost their jobs. They can't, and they're having a hard time finding another job, right?
It's a calculated natural disaster. A natural disaster is just
I understand, but I guess we all agree on this point, right? It's numbers, while they can act as some form of maybe help guide your understanding to solidify that reality into more concrete facts. But the truth is that numbers aside, the straight up truth is going to hit you in the face when it happens, when you lose your job and it takes you 3 to 6 months to get another job, right? Then you're okay, look,
all those superlatives or whatever the word is aside, it's all I know is that Omar already said this. You had a massive injection of liquidity over a very, very short time frame. People need to reset their valuation metrics. They need to reset how they approach the market, how they're valuing assets. In my opinion, and this is a good metaphor is in trading. You look at a chart, you have the optionality to take ticks off, right? To take wicks off a candle, because people are hey, if it's a low liquidity exchange, I don't know if that's true temperature check of market value. So in my opinion, I look at the last 2 years as just a long tail wick in the entire grand scheme of markets. I think it's very, very fair to approach this as an anomaly. And now you're hitting your reset. Whether we've been in a reset from the equity space, I don't really think so. I mean, broad tracking indexes are doing well. Crypto has been in a large downtrend. I don't really care if it's a recession or a downtrend. All I know is we're going this way. We have room to go this way, or we have room to keep going this way. Our jobs, Omar's and my job, his job, your job also, Ash, is to determine what is our inflection point and how do I set myself up at that inflection point to make money either to the downside or money to the upside.
Yep. Yeah. Well, to tackle that exact point and to answer your original question, Dad, how you come out doing reasonably well of a recession is exactly what Akash said. You identify the business models and the enterprise models that used to work in a low interest rate environment, and you short them, and then you identify the new business models that will operate under the new environment, and you sort of long them. And your ability to do this is predicated on you having cash. There's just no other way to do it. So, I mean, Akash sort of put out all the ingredients about 10 minutes ago. Said you need to identify what's not going to work, at least get rid of it. You need to identify what's going to work or think is going to work, have bets there. And in order for you to be able to do this, you have to have, the king of optionality known as cash.
And something that I got asked this question. It's what do you want to do 3 months, 6 months from now? And this could be a general question about how I approach my book, or it could be a general question about life. And my answer is I don't know, because if I know, then I've narrowed the matrix of opportunities that I can offer myself down the line. I love sports, whatever. I love markets. I treat them the same. Treat life, market, sports the same. If you're approaching anything, building a book, building a team, building your life, the king trait is flexibility and versatility. If you can't perform in scenario A through Z, then you are completely useless. If you only can perform under a very specific set of conditions for a very specific scenario, congratulations if you hit that one possibility. But if you are not highly flexible, we're approaching markets, being in cash, so I can do whatever I want to do, you are of no use. You've just narrowed your absolute broad range of things you can do.
The one hitter quitter model, I mean, is exactly that. It's the when the bull market comes around and you have a distribution of outcomes, and you happen to find people that by random chance happen to be aligned to one of those outcomes, and they sort of for some reason they become the new stewards, right, or the new golden firms of the sort of next cycle, and then they consistently underperform, not knowing that the performance was mostly right place, right time, as opposed to any sort of measurable skill. And it happens every single time. And if you don't believe me, go back and look at the quarterly Bloomberg hedge fund sort of ranking and performance. You will see it's a complete sort of lottery.
So do you have any comment on some undervalued acquisitions, or you think that actually they are coming back down to a proper value?
I make the distinction. There are definitely, and not just in crypto, but in the broader markets, there are definitely very, very nice opportunities. Companies that have very fat profitability or very fat margins in general have been making very, very attractive cash flow for a long time, and have been trading at multiples that I would argue were very far removed from reality. And now you can actually pick them up, funny enough, close to par. I don't think you have severe undervaluations. It's maybe points to what Ash was saying before. I don't see any, at least in public equities, I don't see any truly distressed, even in private, the ones that came on my desk, I don't see any sort of truly distressed gold mine. I haven't seen those. Most things are trading at actually slightly above like the historical average in terms of multiples, but nothing that's like a screamer. I don't know, Akash, I don't know what you think, but that
I agree with you. I'm not gonna comment specifically on any companies. I will say that this time is never different. I think you tweeted this out the other day, Omar. But anyways,
there's this nice book.
I don't remember where it was, whatever. But this time is never different. Like, we have a track record of how things operate. The kinds of companies that came out in 2008 exist today, whether in the same form or a different form. Just follow that recipe. Like, this is hard, but it's also like, idiots make money for a reason. The bell curve mean exists for a reason. Like, do the stuff that is obvious. It's very obvious to invest in a company that has a ton of cash on their books, as an example. So yeah, this time is not different. I keep talking about sentiment because, like, sentiment sucks. It's obviously your job to determine the relative suckiness. But it's not like
don't
we're going to
get too
zero.
sophisticated on us. Gosh.
Yeah, I mean, of course, I have the vocabulary of a 4-year-old, but I mean, I left curve everything, and that's why I'm here.
Always left curve when you can.
So I mean,
I would argue that, like, while you're right for sure that, like, invest in companies that do have a lot of cash on their books, like, I think that's like
it's
one
an example. I'm not saying
that's no, but I mean, yeah, okay. So all right. So that's one metric, because obviously also the reality is immediately after a massive multi-year bull run, quite frankly, a lot of people will fall into that category. Like, we have a lot of cash, we've made a shit ton of cash when we shouldn't have made a shit ton of cash, right? Now, how long that cash is going to last, or is it even did they deserve to have that much cash? A lot of folks that right now have cash on their books, honestly, also will not continue living no matter how much cash they have, because the fundamentals of what they were building in the first place, and the people that were involved in building whatever they're building, they're just not fit to continue, right?
Yeah, I think what Akash is saying is, like, at least the starting point is you find companies that are in no man's, they're not in no man's land, right? If you're in the growth at all costs mentality and the party just stopped immediately, you're in no man's land, right? You don't have money to pay rent, like, it's a problem, right? But if you have a fat balance sheet, right, you have a lot of cash,
that's a great first
you have
step.
time to, it's a great first step.
Okay, so yes, Akash, did you have something else to say? Go ahead.
No, nothing noteworthy.
Okay. So next, I want to move chronologically through some of the exploits that have happened and some of the bankruptcies that have happened over the past year or so. The two first ones are bridge hacks. And Omar, I know that you hosted that token 2049 conference where you had panelists from Starkware, Matter Labs, and Scale. And one of the topics that you talked about is that layer twos prevent the risk of a centralized custodian when doing bridging. So the two hacks that famously occurred was Wormhole on Solana. I believe that was 350 million, and the Ronin network. Do you guys have any comments on those exploits? And maybe about the fundamental flaw with bridging? Like, can bridging still be used in the future, or is that entire concept fundamentally flawed and should be kind of thrown out the door?
No. You shouldn't throw anything out of the door. It's saying bridging is like saying sports, right? There's a lot of different things that fall under that category, right? There's the majority of exploits in bridges have been of the architecture of there's a honeypot, that honeypot gets big enough, somebody gets interested. I have a hypothesis of who that, or suspicion of like who that type of somebody could be, because these things typically are very sophisticated. But at any rate, they get interesting, and then the problem is, unlike, for example, an LP pool on a DEX, if you exploit the bridge, the entire pot is up for grabs. Whereas on a particular LP, on a particular pool, for example, you only get to target one pool at a time, and there is a way to like salvage or segregate some of these pools. That is sort of fundamentally the problem, and the vulnerabilities tend not to be on the decentralized tech part or the cryptography part. They tend to be on the part of, oh, somebody accessed essentially compromised private keys, or oh, somebody essentially was able to spoof the identity of a server, or it happens almost exclusively on the centralized bit, right? Imagine there's like a centralized entity running a bridge, and it's not the bridge gets exploited, it's a centralized entity that gets exploited, and that's reflected in damage to the bridge. So that is pervasive, and the reason why it makes a lot of noise is because it tends to aggregate the majority of capital. Is there a way forward? Yes. Does that involve more decentralization by default? Yes. Does it involve more sophisticated cryptographic schemes? Absolutely. That's the way I look at it. The jump one, sorry, not the jump, the wormhole one. Wormhole is owned by Jump. Well, let's just that's yeah.
Right, and they bailed it out. Just for anyone that's listening doesn't know.
That's right. It sort of falls under the same category as in terms of the exploits. So there's no new physics here, I think.
I mean, to be honest, I have very little insight to how like some of these hacks work at a technological level, because I'm not really familiar too much with like the bridging ecosystem overall. But I'd argue probably it's nothing different than really most of the hacks that happen in general across technology, right? Like almost 90% plus are mostly like social engineering or some form of faffing, or like a human is probably involved. Like there's usually someone, it's some centralized like party, like Omar was mentioning, right? Like that has some form of privileged access, and all you need to do is like either social engineer your way for that centralized party to give you something, or just wait for someone to fuck up, right? By fat fingering something, and you just like pounce immediately when that happens, right? But very, very, very rarely does it ever involve the actual technology piece, because tech is extremely sophisticated at this point in time, right? Like a lot of the security principles that are baked into the majority of these code bases are very, very hard to overcome. But humans are remarkably easy to just play with, right? So it's usually I'm guessing that's the majority of what's happening, not on the technology part at all.
I have nothing to add other than bridges are Lindy, really.
Yeah, meaning by that he means typically the ones that haven't been exploited have a lower probability of being.
Exactly. You iterate, I mean, it's not DeFi is going to be if you remember, I would classify it. Yeah.
Okay, so moving on to Terra Luna. So I'd like one of you, maybe Akash, to explain exactly how Terra Luna collapsed. Are there fundamental issues with algorithmic stablecoins? And to what extent do you think Terra Luna collapse hurt the crypto market in general, as opposed to the FTX collapse?
And let me add one more thing to that, Akash. Where were you when Luna depegged or when UST depegged?
Oh, sure. I'll start with the last question. When the tribe was the tribe pool, right? It was a DAI UST.
Tribal, yeah,
Yeah.
yeah.
So when the tribe pool depegged, I was driving up Second Ave, and my buddy called me, and he was like, "Hey, you're about to lose a lot of money." And I was like, "Okay." And then I went to bed, and then I woke up.
and at that point,
dude, it went to like 87 cents overnight. And I was like, "Oh shit, that's not good." So I woke up, and the good thing was, that was a Saturday night. Only stupid people log on Saturday night. So I was like, okay, it'll go back up. So and then I got out of UST on Anchor Sunday morning. I just like I got breakfast, went home. Yeah, it was an easy.
So
time.
at
Obviously,
that point,
the thing was that I don't think people back then knew how like these pools worked. I still don't think they do, but whatever. And I didn't really know how it worked back then. So I was like, I don't know how this works. I'm just in here for the Ponzi yield. It's gonna blow up at some point. And it sounded like it was blowing up at that point. So I just was like, okay, I'm out. And it blew up 4 hours later. So that's where I was. I got lucky. A lot of people didn't get lucky. What happened? There's a lot of places that can explain it a lot better than I can. But what I will generally say is that liquidity in the last NFT yield, whatever cycle, 2020 to 2022, came in the form of cheap yield and NFTs. That was the way that liquidity found its velocity. In our system. UST was an algorithmic stablecoin that used the burn and mint mechanism based on bonded assets in order to create more UST. The mechanism of the flywheel was that people took the UST and then deposited an anchor that was paying out an extremely high yield. Correct me if I'm wrong. I believe that a lot of that yield was, right? Yeah, it was roughly around 20%. It was higher before, I believe, or either there was it was at 20%. There were proposals put forth to lower it because they were like, okay, the reserves are being drained. But again, too little, too late. Anyways, I don't remember exactly where the yield was coming from because it didn't make a lot of sense. But I know a majority of it was coming from validators that were staking on Luna. I don't know if they were running. I think Anchor was depositing money inside of Magic, or not Magic, inside of Abracadabra, and they were
that's with
like
the ticker MIM.
Yeah, but
correct?
that was actually
Magic
later
Internet
on.
money, just for those.
No, it was earlier on. They did that originally, and then they closed that down. That's how they're making a lot of the yield. That's how they pumped the reserves initially.
No. But when it started, you could still earn yield on Anchor well before MIM ever launched.
No, yeah, I know, but I'm saying right before the blow up, they were on MIM. They had deposited a lot of and that's
how much yield was Anchor promising? Was it like 20% or something?
20%.
No, it was like
fixed. Yeah, it was around like 19.3.
Didn't all this start when Anchor decided to go to like a variable fixed rate, like a variable rate?
No, it started beforehand. They went to a variable model because the reserves are being drained. Because people weren't bonding more assets. They were just like, okay, that's what happens. Like if you're not, that was the thing. It works well if there's novel value coming in. This is like a true principle for anything. If there's novel like economic value coming in, but people were literally just playing like, hey, I can get a free 20%.
Yeah, exactly. The most basic question was just follow the money. Like, where was that money coming from? It's that simple. It's like 20%, great. If somebody is paying 20% to take the other side of this trade, fantastic. And so long as those people are there, this is a profitable trade. That what people realized at some point after the tribe pool started to destabilize was there was nobody on the other side.
It's
or
empty.
that.
Yeah.
Did that not ever raise like a red flag from the get-go, seeing that 20%?
It did, but people
I can
don't
assure
care
you.
if money is cheap. Like they'll ignore it. It's the same thing with FTX. It's like money and venture funding was cheap from FTX. I'm willing to sweep some things under the rug. Like I think
No,
that's how
but
people approach
let's
it.
be clear about Anchor and specifically. There were a lot of people that
Oh, yeah.
knew about it explicitly. This was very well known that like this was bound to happen. And there's a lot. Well, to be fair, there are all people on both sides. They were very vocal about it, but there's plenty of people. Like there are very few sophisticated actors that were surprised. So the FTX business caught a lot of people by surprise, genuine surprise. The anchor business did not catch a lot of people by surprise.
Well,
At least
that's
not
why that's why I pulled when I did. I was like, it's gonna. I knew it was gonna blow up at some point.
Do you
But
think?
yeah, I mean,
Do you think that Luna and UST could have survived if Anchor never existed? Is algorithmic stablecoin still a viability?
yeah,
I mean, the mechanism in principle is not much different than how a central bank operates its monetary policy. Like just the very basic principle of it is you have assets that come from some sort of economic value or that are taxed away from some sort of economic value, and they are depending on the demand for the currency. They are used to stabilize the price of it. In principle, you can think of that PID controllers work in very similar ways. Now, there's a lot of destabilizing factors and there's a lot of positive and negative feedback loops that go on into it, but at a very high level, it is certainly possible. But it is an extremely difficult coordination problem. It is an extremely difficult control problem, like the theory of optimal control, and it's highly unlikely that they would have gotten it right, regardless of the underlying mechanism. Now, to be clear, there was an idea of what Anchor was doing, and then there was actually what Anchor was doing. Okay, so that actually was a big part of the problem. Like there was this, I don't want to say advertised, but there was, if you go read the white paper and then you go read the code, they did not reflect the same thing. So that's sort of all I'll say about that. But
I mean, regardless of the code, which obviously, even no matter how insanely good the code was put together, I mean, the algorithm worked well, right? It was fine, and there was no issues about like whether minting or burning things in response to like movements and volatility in the market. Like you can algorithmically stabilize if you want to, as much as you want to, but at the end of the day, like because of the mere fact that there wasn't any value added at any level, right? From any of like these pairs. At the same time, central banks can argue. You can argue that central banks are doing the same thing, and like the fuck.
And they are. If people would just wake up and decide to not hold a sovereign currency, it will be valued at zero. And
except that it's almost impossible for that to happen because unlike like the decentralized.
If you remember. You remember Weimar Germany, the Weimar Republic. You remember Zimbabwe. I mean,
no, but these are different. These we're talking about like when like shifts in the power balance across the globe. At the end of the day, like so you're bringing me to even a better segue of like what I'm trying to prove here. It's like it's almost every single time when those moments happen in real life, like it's when there's no physical power actually to back up that claim anymore, right? So central banks, the majority of their power comes from two different things, right? One, there are real assets in the physical world that this government controls and can just sort of say it has real value. Like I got all this gold, I got all this like whatever.
To some extent,
right?
To some extent, it's not really how it works, but yeah.
Well, I mean, and then the other side is that there's firepower, right? There's little firepower for these central banks to say like I mean the U.S. dollar gains its value not just.
I don't think we need to spend time talking about central banking right now. But
it's an interesting analogy. It's an interesting analogy, I think.
Yeah, anything is an interesting analogy. I can talk about potato chips. Like I can talk about like the bodega, like restricting which potato chips I buy, and you can like commoditize or like you can add a currency to like a coin. Every time Akash gets cucked by the bodega guy for the potato chips he wants, you can burn a new token. I can create a metaphor for. I can create a metaphor for anything. All this really matters for the audience, really, or people that are watching this, is that yield was cheap, money was cheap because yield was so high. That was your liquidity flywheel, and a large part of the blow up a large part of the blowups that follow that was preceded by the fact that that yield was a ton of money that was locked up on Anchor, no longer existed. Whether it was hypothecated in, sort of fractured in a fractured way, that doesn't really matter. Like, I'm going to segue this segment for you, Zad, into the 3AC.
That's
FTX
exactly where I was
Alameda
going.
bullshit, because
Exactly where I was going.
I don't really have a lot to say about it other than 3AC. These guys were arbitrators to the max. They fraud, no fraud, whatever. They got blown out on a trade that they were caught off signing. And this space, the one thing that hasn't been sort of propagated or highlighted enough is that, yes, they got caught offside, but this is not a big enough space where there are credit facilities or folks that are going to margin them to keep that trade alive for as long as they thought that it could stay alive. FTX, I don't have anything to say other than they committed fraud.
Well, we're gonna get to FTX in a second, but maybe you guys can speak to 3AC a little bit more and explain what exactly is rehypothecated leverage and how did they use it to their advantage.
The oldest story in time. They promised like insane returns and like
But let's just explain to viewers who are listening.
They didn't promise insane returns.
No, there was a bit of that on the treasury management side. I think that's what Ash is referring to, but that was not part of the core problem. That was nowhere near.
That wasn't.
Well,
all I'm going to say, because this is still an arbitration, and we don't have to get into all details. But if you remember what happened with Archegos, this was in traditional finance. It had a lot of similarities where there was some collateral, and there was a lot of leverage. And when people really dug into the details, and they realized there was not enough collateral, or at least the amount of collateral that turned out to be available was a lot less than what people thought. That was really at the core of it. Now, how that came about, whether it was because of some sort of valuation scheme, whether it was some sort of misrepresentation, all of that we don't know in great detail. We just know that people thought there was X amount of collateral. Turned out there was X over 10 amount of collateral.
Or complete disregard to risk on the lending side. I mean, if you look,
no, that has to be the case only because that is how you end up in that situation. Or if you think, I mean, by the way, in 2008 was exactly the same problem where you thought you had X collateral and you ended up with X over 100 collateral. That's the MBS sort of CDS.
And then the moment that the lenders decide to take a deeper look on the balance sheets instead of just looking, even if the collateral was not equivalent or anywhere near where it should be, right? There could have still been some form of salvage if the collateral itself, that 1 over 10 of whatever you just borrowed, actually had some form of value. It's the same thing in 2008, right? You'd look at the bonds, right, and you realize everything is just garbage. Even this small amount that is there, it's just not there, right? So then it comes into the territory of all right, this is complete fraud, right? There's actually no collateral at all, right? So it's I don't know if this is true or not, but I've heard multiple stories, specifically about the 3AC situation, where they were able to borrow hundreds of millions of dollars, from a specific counterparty, up to X amount of billions, right? With simply by emailing their balance sheets, right? That, hey, we've got something.
I think the hesitancy here is for people to talk about this is because when the details come out, they will be more embarrassing for the lender, less embarrassing for the borrower.
Yep.
Yeah. So
all the borrower has to do is ask for money. That's it.
Do we know? The lender's only excuse is well, everyone was doing it. Probably that's the problem. That's where you are today. Where it's
I think that's all we need to say about that.
Yeah, we can leave it at that. But it's I do think that the lenders in the space have really done a tremendous disservice to everyone. Now it's not like they owed everyone anything at all, but I'm just saying that in terms of performance, lenders in the crypto space get a solid F in my book.
Yeah, they do get a grade even. at all.
So we
Yeah.
know that Genesis was one of their largest lenders. Do you guys have any comment on Genesis connection to 3AC or any of their other large lenders?
I think
specifically?
so. Just given the situation that Genesis is in and everything that's happening, I think it's very early to say like what's going on a lot specifically in detail. So I think we probably should move on and like let the situation happen. All we know from a fact standpoint is that 3AC is gone, and the biggest like takeaway that we just discussed, which is obviously managing risk and understanding like what you're getting into, and never fall into like the oldest trick in the world where someone is promising you an insane amount of like return on something that seems almost too good to be true, right? It's the same theme over and over and over again, right? Like, but greed is an incredible driver of our species, and we tend to fall into these positions. Sometimes the blowout is very, very big, and we're all very sad. Sometimes the blowout is just, it's not that huge, but continuing to see every single time things will blow up, right? But people just don't tend to learn that much. So,
but the common denominator is it's always funny.
Oh, it's hilarious.
It's true. The memes are where we really shine, right? That's where we are the best, to be honest.
Crypto is the most expensive memes of all time. It costs a lot of money.
I'd argue the memes that come out post the blow up are more valuable than any of the collateral that ever got posted like throughout the whole situation, right? It's like quality content. Like I'd pay money to see that shit. So
I'm glad that we can still find humor in these situations.
Well, if we can't find humor in these situations,
and then we just go kill ourselves at that point.
Yeah, dude, it's turning somber real quick.
What are we talking about next, Dad?
Yeah, what's on the agenda?
Next up, Celsius, BlockFi, and Voyager.
How about we talk?
Those are all the same thing. We've already covered that.
I propose we talk more about like great. So we spoke for a little bit about like the flush out.
I'll give you the synopsis.
Just summarize like and what's happened.
Customer deposits used to run a hedge fund.
Yeah.
Okay, good.
And then I guess that applies for FTX as well.
Well, I think for FTX it was used to do something else. I think if it was used to run a hedge fund, it wouldn't have been that bad. I think they did a lot worse than without.
I think FTX is more on the premise more of like a massive like criminal act. It's not I'm not. This is like I think everything else can be argued where something went completely wrong when there wasn't an intention for.
Yeah, there's a fine line between negligence, right?
There's a fine line in between using customer deposits to buy a ton of MDAF and no one ends up. So that's
when you literally use customer deposits to buy like real estate. And
anyways, that's a topic. That's a topic.
But like this is the one last thing I want to say about this, to be honest, because I do have.
I don't want to talk about.
No.
You're gonna get muted.
I want to make it clear this is one of the very few times in this entire industry since I've been here, which is officially been here, starting building Kemet, been almost like 10 months, 11 months. But overall, in crypto since 2014, like being involved to some extent. But like this is the one time, unlike any other event, where I have a very clear understanding of like what actually happened. Like I genuinely believe like that now. Sam was actually a malicious individual and did commit to some extent like literal like just a financial crime, straight up. Like no,
a lot of stuff has happened and a lot of crazy stuff, but I mean it is what it is.
That's so like
how did we get
great value add?
No, it's not a value add. It is
hold on. Zach asked a really good question. How did we get here? I'll tell you how we got here, buddy. It's called the suspension of belief.
How do you
That's
think
how we got here.
This is a very classic Omar thing. It's the suspension of belief theory. Now let me pull up the Wikipedia article. Can you read it? Can you read it to me, please?
Yeah, this is what happens. You get a set of facts. That are, I'm sorry to say, ambiguous in the sense that they can be interpreted.
Just for saying sorry to say, just fucking.
No, you can interpret them in a positive light or a negative light. You have this esoteric company that came out of nowhere. All of a sudden, one of the fastest growing fintechs in all of history is valued at multiple tens of billions of dollars. With this very, very sort of esoteric group of people running it, and you can look at the set of facts and say, is this consistent with reality? That is where you sort of engage disbelief. The other way to do it is to suspend disbelief completely and say, wow, this must be, this will be the new $10 trillion company. This will be the most interesting thing we've ever seen, only because we're around to see it, only because we were involved. If we were outside objective spectators, we would have certainly asked very different questions or had very different statements. But because we somehow were lucky enough to be here, the laws of reason are suspended in our favor, and instead everything is going to work out just fine. This is how we get to these things. This is how you get the South Sea bubble, where His Majesty the King of England loses money speculating on South Sea stock. Right? The suspension of disbelief is fundamentally why you always get what Ash was saying, this sort of repetitive behavior. It doesn't matter if we're talking about 2001, 2002, 2008, 2015, 2020. It doesn't matter. It's we are, as investors, are first and foremost human beings, and we like a good story. If given the choice, with the same set of facts, we have a bias to prefer that these set of facts tell a story. This is actually a beautiful result. Amos Tversky and Danny Kahneman, who studied a lot, who sort of pioneered the field of behavioral finance. This is one of their core conclusions, that given a set of facts, identical facts, if you present them to 10 people, more than 50% of people would prefer that these facts actually represent a story, even if embedded inside the facts are no other reason for you to suspect that they are related in any way. We are just biologically primed to do this. Okay, so this is a very dangerous way. It's called fantastical thinking, right? When you have this sort of thinking as an investor, and you suspend disbelief, and you have due diligence sit in the sort of backseat, and you let your emotions and you let your ambitions, however pure they are, get into the driver's seat. This is how we got here.
It's
essentially
confirmation bias, basically. So you want it to be true so bad that every single story, every single fact, every single piece of evidence, you'll look at it from a single lens, which is, let me figure out how to make this new piece of information follow that story I already bought in, like, early on, right? So that's why the power of like this confirming like evidence is incredible. Like, very few people are able to do this, right? Because it's like you are wired almost at the root level of who you are and what you are as a being, to find things that fit your view of the world, right? You don't want things that just give you this dissonance, right? Because the human brain does not want to spend energy into having to reason and actually analyze and sort of come up with conclusions. The human brain just wants to keep on doing what it's doing over and over and over again. That's why people get addicted to drugs. That's why people get addicted. Like, it's reproducible outcomes that make you feel good. That you spend way less energy than having to counteract something that you've already had done before, right? So your brain just doesn't want to get into this fight. It just wants things to move forward. So you'll find a way to confirm your biases, and that's just obviously add greed to that formula, and then all of a sudden you're like, it's very hard to stop yourself from thinking that, yes, Sam is going to be the next trillionaire, right? That was a headline on Forbes at one point. Sam might be the first trillionaire in history. Great, I knew it. Like, I'm in FTX from the get-go. All right, well, awesome. Well, that you could keep on regurgitating the same shit over and over again. And again, remember, none of us on this call are sort of immune from this. I just want to make it very clear, because obviously, in hindsight, everyone comes off as like, sounds like smart, sounds like they know what they're doing, right? But every single person, no matter who they are, no matter how smart they are, will inevitably fall into that trap. The only thing that you can possibly do is hopefully like attempt to train yourself to limit your exposure in general overall, right? Because you know that this is something that you're gonna do wrong and you're gonna commit that mistake. I think one way to counteract this is to train yourself to generally not expose yourself too much to anything, no matter how incredibly appealing it might seem, even if it was true, right? So even if like the evidence and the facts are right, it's not too good to be true, the returns are great, it's gonna look like it's great. Never try to like sort of go all in, unless you are willing to lose it all, right? So
one of the issues that was brought up is that Alameda had a backdoor in which there were no auto liquidations like other customers. Michael Saylor referred to it as God mode, in which they're the only player in the casino who could never lose. Do you guys have anything to say on
the
this?
God mode thing is referring to I don't know if we should get into details of all this, but the head of compliance or head of risk or something at FTX was formerly involved in some online poker business, whatever. Actually, know this?
Yes.
That was the piece of code that was in contention was actually referred to as God mode, and that's where the terminology come from. Let's move on to the next question.
Let's go to the next topic, Zed.
I really don't. I don't have any. I have no idea. I've not. I've heard of
the horse has been beaten to death.
It's gonna be hearsay at this point.
Okay.
Yeah.
So altcoins have taken a massive hit, unsurprisingly, and so my question is: has your stance on Bitcoin as opposed to Ethereum and altcoins, alt layer ones, layer 2 tokens, has your stance on any of this changed? Do you feel now that you need to allocate more to Bitcoin, that it's a more solid asset, it has more regulatory clarity than a lot of these altcoins do, which many people would refer to them as unregistered securities trading on unregulated exchanges? Has your opinion on any of this shifted?
I fundamentally believe that dick butts are a better store of value than Bitcoin. And
what?
Say that again.
Dick butts.
Dick butts.
What are dick butts?
Yeah, what is that? Just can we clarify?
Have you ever like put a picture up of a dick butt? Okay.
Oh, okay, yeah, I guess.
Okay, all right.
Yeah, those are tremendous, a tremendous store of value. Not only because of their allure, of their graphical allure, but also because they capture what in a more succinct way what Bitcoin was trying to do. They capture a culture, they capture a meme. Okay, with Bitcoin,
hold on? Are you like laying the case that dick butts are actually more valuable than Bitcoin right now?
Absolutely. Bid the dicks and the butts. Bid the dicks, dude.
Okay, let's get sure.
Hear it. Hear the argument. Hear the argument. No,
okay,
the premise of Bitcoin being a store of value is a very complicated and convoluted meme that people have been trying to argue their way into and out of for quite some time. I argue that the Dick Butts has a similar meme, but it's much clearer, it's much cleaner. And if that's what you're looking for, and if you're just looking for that narrative, it's much easier to reflect that bet using dick butts.
What separates a dick butt from a milady?
Presumably the dicks and the butts.
Clearly, yes, but
no, of course.
The argument is being made that its intrinsic value is a function of the network effect, which is its mimetic appeal, right?
Okay.
Miladies are extremely polar.
Yeah. I don't think obviously the argument here is that it's more not just this particular collection, but NFTs in general. I think to the extent that you have an NFT or a digital art collection rather that represents a very specific, very articulable meme, I think it actually can and will be more successful than Bitcoin. The problem with Bitcoin is finding a true footing for the narrative. Okay.
Okay, go ahead. I'm sorry.
Go on.
I cut you off.
No, that's really all I had to say.
I was going to say that. Do you think that the network effect of a dick butt or a milady, of a PFP NFT gets diluted as people try to find more commercial applications for NFTs outside of PFPs?
No, I do genuinely think that there will arise a certain class of them that will will be so absurd, and that's why I like the dick butts, because they are so absurd that it's almost impossible to find a like reasonable commercial like value to them, besides the fact that they just exist. Okay,
Yeah.
even with Bitcoin, people have tried to use them for peer-to-peer payments, for remittances, for things like that, right? I'm trying to find an example of something that is so absurd that it could only represent a meme. That's sort of what I'm saying. It's a clean representation of that thesis.
Yeah, okay, I get it. Okay, I mean, I get it. I just feel like the counter argument to that is that a dick butt is extremely vanilla in terms of complexity on face, whereas something like Bitcoin needs to iterate.
But that's exactly it. That's exactly it. Because
I'm not saying that you're wrong. I'm just saying that the counter argument somebody's going to say is that it's too vanilla in complexity, whereas you have a system like Bitcoin that hasn't reached its. The argument that will be posed is that it hasn't reached its full potential. LN is only starting to break out of beta, so that's why remittance argument is actually ramping up. So Bitcoin really hasn't reached its final form because you're trying to solve something that's more of a cultural phenomenon that needs a zeitgeist rather than. I'm not saying that NFT. I get what you're saying because NFTs are a lot more approachable. Dickbutt is a lot more approachable. The folks that are using crypto are, for the lack of a better word, we're kind of dim-witted, right? I mean, so like something like a Dickbutt is very appealing versus the argument that's being made about Bitcoin, which aims to be founded in like this very obscure economic theory.
Exactly. You got it.
So I understand.
Is it really obscure though? Like, I mean, like
well,
this.
no, yeah, definitely. I mean,
are
you, dude? Can you name people between 18 and like 30, like 6 years ago, that knew who John Mises was? And the only people that can tell you, oh, I know who John Mises is, I know what Keynesian economics is, are people who like subscribe to like Bitcoin newsletters and were like, oh yeah, like I know XYZ, who like has written just like the recycled blog post about like why Bitcoin follows like a Mises school of thought. I'm not saying that it's wrong. I'm not saying that it's right. I'm just saying that it's obscure because people that they don't understand macroeconomic theory. They don't understand economic theory in general.
But they don't. They don't need to understand it for like the net for these principles to apply to the network. They participated in it, right? Like what I'm trying to say.
How can you understand something if all you're doing is copy paste someone else's opinion?
So the pro argument for Bitcoin having probably more value than dick butts is, I mean, it's the way I look at it is like, one, the network effect for Bitcoin is there from, its diehards are there. There are people that are just, Bitcoin maximalists they are not exactly a power to, to just, completely disregard. There is a network effect that exists in Bitcoin. It's deflationary, like in terms of actual nature. So it's almost like baked in for that value to one way or the other continue increasing or like kind of like stabilize when things like just completely go weird. On the third front, the technological effort that has been put into the network being, and working the way it works today, that has value. The code that has been written has value. Like the brain power that's been spent to enable this level of sort of decentralization on a network, even though we have yet to figure out, is there really a utility for Bitcoin? Is it actually a good digital fund?
I agree with you. Right?
Use it as whatever, right? Like that is true value, right? So it's can we argue that Bitcoin is a digital form of like reserve or equivalent of gold or whatever? Like I don't care about any of this. What I do care about is that, is there value within the network that has been built over the past like 10, 12 years, like where you can look at and be like, yes, there's actual economical value that's been spent into this network. And because of the nature of how it's built, that value gets locked because it's not infinite. You can't just get diluted forever. I think, yes, that argument is very, very sound. I don't see how dick butts can be compared in this situation right now.
So I get where Omar's coming from, and I'm going to pose this from the perspective of somebody who Omar and I are actually on opposite sides of this, because I personally don't think that we can continue to do what we're doing, being part of this ecosystem, if Bitcoin isn't king. What you can have a discussion about that, but I'm just going to set the context of what I'm about to say based off that. And so I get what Omar's saying, and I kind of agree with him in terms of why something like a Dickbutt, or let's just probably put in an NFT PFP, that has a strong narrative that appeals to a community of ardent supporters, is very similar to the value that Bitcoin is pushing. And I think that it's semantics aside, Bitcoin's network effect, its intrinsic value, is very much founded on its network effect, and that was extreme. That was highlighted very clearly around the Segwit 2x event, right? People said large blocks, small blocks, BCH, ABC, Bitcoin, whatever flavor of coin. The thing that makes Bitcoin Bitcoin are the people. It's not people who are passing. It's not the miners. Yeah, miner validates network, is secure, whatever. If the community doesn't believe in a soft fork or a hard fork that happens on BTC, and this was literally put out through the mailing lists. If we don't believe in this hard fork or this soft fork, we'll go create our own coin, and we hope that people will come and join us. This was a big thing around why like interest in crypto had died out. You saw guys like Garzik leave because people were like, hey, if we don't generally like what you're doing, we will quite literally fork off the network value that we're providing you and go create a new coin. Like Bitcoin's moat increases as things that attack it make it more lindy. But there's also, you have this switch that can turn on and off, presumably still, that exists in my opinion, where if something fundamentally changes, the biggest example is you get rid of the supply constraint and you create a BTC that has no supply constraint, you'll see sort of factions separate, and then there'll be a discussion around, is this true BTC, is that true BTC? Again, okay, following down what I'm saying is that it comes down.
That happened multiple times. Like a forking of the original, multiple attempts have been like, okay.
Yeah, it's not BTC is not the middle line that's followed. I understand that it's the forks. It's it's all the different versions of it. Yes, it's changed. BTC 1.0 is not what it is today. No, it's not what version 24 is today. It's very different. I understand those fork. What I'm saying is the community has followed those forks all along, and that's what he's saying. And I agree with it from that perspective. That's
okay.
It.
Altcoins eventually are no longer going to be altcoins.
Well, we're leaving.
I think we hit the topic that we wanted to cover here, which is how do you apply the store of value narrative or of Bitcoin? Is that applicable elsewhere as well? I think
100%. Yeah, 100%.
Which figures in the crypto space right now, or maybe over the past few years, do you actually consider to be trustworthy? Do you feel safe following them?
You got all three on the call right now.
Yeah, zero. If we learned one thing, there are no saints. Okay, that's just how life works, right? There are people and there are mistakes, and people tend to do mistakes. And if you live long enough, you'll do enough mistakes. Okay.
And so to that point, then
the whole premise.
Why should people? Just let me finish.
The motto of this industry.
Why should people have trust in like CZ, for example, that he's not doing the same thing Sam was?
Nobody should trust anybody, right? Don't trust.
And yet they will put their money there. And yet they will put their money there.
Their money, their problem.
People want to make money, dude. People are like, people want to gamble. Are you kidding? People want to gamble. That's it.
This industry was built on the premise, or the remnants of this industry were built on the premise: don't trust, verify. That's what cryptocurrency enables.
You just have to hope you're not the last marginal buyer, really, and that's what everybody's hoping. I'm not Binance. I'm not the last marginal buyer. Of course, that's what we hope. But I mean, like people who I look up to, I'll be honest with you, I can count on one hand the amount of people that I've actually truly liked in this space. One of them is on this call. No offense, Ash, I like you.
I
like you, but I like you, but
don't worry.
I like you, but to be quite honest, when I say what I let off with is I will only tell there are very few people that I'll be like, oh, talk to this person, and I can literally just blindly be like, talk to this person, and I could die, and that person's reputation would be unhinged. And Omar is one of those people. So I mean, smart guy. He's based. I mean, let's leave it at that.
Congratulations to both of you.
Ash, I like you. You come from the shot, unfortunately.
Maybe to that point, did any of you have a mentor or somebody that you looked to in the first early years of your career that helped you get to where you are today?
I think there were hundreds of people that helped me and continue to help me today. I don't think there was a single person. I think at every point of my journey, there were people who were willing and able to help me, and I will forever be indebted. But there's no one person that I can single out. I think there's just that's the only thing that you can deliberately do is and be good at. That's the real skill in life, is to surround yourself by people that are skilled and generous and are able to sort of help you along the way. And I think that is the only common denominator between every successful person, or everyone who's survived long enough, is that they've surrounded themselves with people that are smarter and more generous than they are, and they're able to sort of help them.
I kind of agree, but I would say at my last job, my old boss, yeah, I've never had a mentor. I don't think I've ever been serious enough for somebody to want to mentor me. Yeah, my boss in my last job, good guy, liked him a lot. Was really smart. You don't meet a lot of people who are meticulous and focused like he was. So the way he approached, I think, crypto in general, and then operating a business was admirable. But yeah, I mean, I do think that like to thank the amalgamate of teachings and observations from people around me. It's your network is really the most important thing. My mother liked to say, show me your friends, and I'll tell you who you are. I think all of our parents probably on this call told us that. And yeah, so thank you to my friends.
And your mother.
And yes, of course, always.
Ash, anything to add, Ash?
He's not gonna be able to answer.
Well, yeah, I mean, it's
Is Zad one of your mentors?
absolutely. I mean, Zad is a great friend. But no, it's it's the same thing. I mean, I think overall, I mean, I came to this country like in 2011. I think Omar and I like share a lot about like that background, and you know, it's mostly it's just the network effect. Like people that you were ending up, you know, surrounding yourself with are that's who you are today as an average, right? With additions of your own sort of discipline and diligence and trying to get things done. But I'd argue it's mostly been, you know, 2 or 3 friends of mine throughout my life that I just deeply trust to constantly provide me with like the most honest and brutal feedback wherever and whenever I like tend to stray, because that's your journey is just not linear. You're always gonna have moments where you are fucking up, and the most important part when that happens is because you're probably not gonna recognize it, is to have someone who genuinely cares about you and is not interested in getting anything out of you, but just cares about making sure that you are on the right track and you are continuing to grow. That person, if you have that person in your life, like hold on to them, because they're going to be the most important person throughout your like career, right? And throughout your journey of growth in general. You need someone that can be very brutally honest with you, but also incredibly constructive when they're giving you that feedback. So it's not just, you know, a yelling coach. You need a yelling and a loving coach, right? And someone that is actually, yeah, you need someone that loves you. Like you do, like sounds like you've had zero love in your life. Like, what do you mean loving? You need love in your life. You need someone that actually does love you for who you are and wants to see you in the version of who you are.
What the hell is this? What is this? I thought this
was
like
all right. Well, speaking of,
we're talking about mentorship, I guess, but
okay, I
love you boys, but I gotta go. I gotta go.
Adios.
Peace, everyone. Thanks for listening.
The question is, what does it mean to be successful? Do either of you want to answer that or no?
I think that wow, that's a good voice crack. Success is, I don't know, to be honest, and I don't think I'll ever know. Fuck you.
I know.
There's I'm gonna answer this by shilling a comedy special I watched a few years ago. Anyways, I watched a comedy special a few years ago with Andrew, who is my co-GP. It talks about like life, and it uses the metaphor of a jigsaw puzzle. Where at the center is obviously the center of the picture, and life center could be in like family, whatever. And then on the outside are all those things that support that pillar, that central pillar. I think if you can complete your puzzle, you're happy. I don't know. I don't know. I'm 28. I don't know what happiness is. I think that you just, I hope that I like the people that I choose to surround myself with. I don't know. This is such a loaded question. I don't know.
No, I think it's simple. So from my perspective, at least, like I think it's just it is having people that you deeply love and at your core being around you, that you're able to and you're able to share with them like the triumphs, the wins, no matter how small or how big they are. That's what success is. Like I don't think I'm ever going to change that definition ever in my life. Like it's just the you and everyone that you really deeply care about, like super deeply care about, are healthy and are able to consistently communicate, talk, and hug each other potentially, and like kind of like just enjoy the wins. That's it. But listen, it doesn't matter. It's fucking just go and surround yourself with people that you love and love you back. Like that's what success is. If you can't do that, then you whatever the fuck you.
That's a principle. Surrounding yourself with people who like you is a principle. That's not a result.
No, it is a result, because you're not going to be able to do that unless you yourself are a person that is worthy of like other people like loving.
Okay,
like
sorry, wait. I guess yeah. I mean, okay, fine. Like that's like extrapolating.
Like strive and put effort to succeed into having individuals surrounding you constantly that are giving more than they take. Right, that is success. If you're able to do that, you're successful.
Yeah, okay, that's fair. I mean, I think the general principle is that a lot of people try to define this question very quantitatively. But it's just probably like an amalgam of like experiences.
All right, with that, thank you everyone for listening to episode 1 of the Zad Mahenna podcast with Omar, Yehia, Muhammad Ashmawy, and Akash, Nath.